Hi everyone, this is TJ, the Backpack Trader. I'm here with one of my students, Chiffon Hayes, and he and I have been working on creating a trade plan. He has a unique situation, and the trade plan needs to fit his busy lifestyle and his personal work schedule, something that we're all having to face. I thought it would be useful to record this session. We are going to look at his trade plan data. He's been putting it into the UTA spreadsheet, and we're going to see how it looks. So, Chiffon, say hello. Make sure that you're coming through the mic.
Morning, everyone. Morning. Hopefully I'm sounding pretty good and clear.
Yeah, I got you on my speakerphone, so hopefully you are. So,
I hope so, yeah.
So let me just set the stage here. Chiffon works like most people and wants to day trade real early before the markets open. And he's been trying some ideas, and one of the trade plans he's been working on is a micro NQ using a custom Renko chart. All right, and he's got a lot of trades that he went ahead and put in, basically over 3,000 line items. And he's been testing all 3 targets and a trailer. And this is with Catapult Trader, I believe, Chiffon?
Oh, we're doing Counterpunch.
Oh, Counterpunch. All right. Very good. Counterpunch Trader. You could see a lot of trades. There's a random distribution of wins and losses. And you were explaining to me that it was doing really, really well up until the last few weeks.
Yeah, so the last couple weeks, man, just that's why I kind of called, looking to see, man, was I doing something wrong or was something just happening? But then I kind of remembered, hey, in a winning trade plan, we're going to have some losing sessions. We're going to have some losing weeks. And so just kept rolling with it. But up until beginning of July, roughly, fairly consistently doing well. Nice profit factor, good average net. Everything was looking good.
Yeah, so it's normal, and I've learned this over the years, that you could have a month that just seems like it takes the wind out of your sail. It almost feels like getting kicked in the gut, and it's what tests us, because nothing is going to be perfect, and sometimes a trade plan will kind of phase shift. Guitar players know what that means, but it just gets a little bit out of focus and out of sync. And then it shifts back into phase, and usually once that happens, the winners come pouring back. And we see that when we look at an equity curve. Looking at your equity curve here, and this is going all the way back to June of 2021, so a year. There's like over a year. Oops, I'm trying to get this lined up so that it's not. Let me make it a little smaller. All right, so look. Here, for example, was a trouble spot in October. And this is enough to get anyone to quit. But again, if you quit, you miss this coming up, right? And so right now, you're experiencing this. Am I correct?
Yep, that's right. That's right where we are right now.
So in the big picture of things, it kind of fits right in with some of the other drawdowns we've seen all the way up to here. And to go from zero to over $12,000 with a micro contract, which is literally $2 a point, imagine leveraging that up with power of compounding. So there's some amazing information just at a glance here. So I want you to think of this as the forest, your equity growing, and you need to clear cut some sick trees to make room for new trees to grow. And every trade in your forest, or every trade on your spreadsheet, I should say, is a tree in your forest. And you got your win-loss column. It's a random distribution of wins and losses, right? And you're not necessarily going to trade to all 3 targets and trail, but when you have the information in here, you could explore and get statistics on which ones are the best to use. I mean, it could be that you just trade everything to just target 2, or you go to target 2 and 3, or whatever. You can learn that with all this data. And we're not really going to get into that on this call. What I want to do is show you how to see what this would have become if you were increasing your position size as you grow your account. That's the key, right? Because what you're seeing here is the growth of just one micro contract on targets 1, 2, 3, and trail. So each trade is like 4 micros, right?
Yeah, that's what we got going on this DTA.
So if it's going up and up and up and up and up, and you're sticking to a 2% risk, then you're going to be increasing your position size. Maybe you're going to reduce it a little when you get into drawdown, then increase it, reduce it, increase it, reduce it. When you get up to here, it'd be interesting to see how many contracts you would have been trading using a 2% risk profile. And we could look at 2.5%, and we could look at 3%. We could look at different risk parameters. All right, so the first thing we're going to do is we're going to show the stats. And, you know, these are modest stats, 56%, and I'm sure it's a lot, you know, it's gone down a little since you're in a little bit of drawdown.
Yeah, I was going to say more of that recency bias is kicked in right about now. Usually I'm averaging 60 plus and some change. You know, it kind of fluctuates a little bit.
Yes, and that's normal, and a lot depends on the range of trades you're looking at. Also, I noticed your profit factor was, you were saying it was up in like 1.55, and now it's down to 1.4.
Yeah, 1.55, yeah, somewhere there.
Yeah, so these are obviously moving lines in the sand, and sometimes they go down a little, and then they go up a little, and you could actually see when you look at this, these are your stability graphs that show you the weekly results, and you have a lot higher extremes on the upside than on the downside for the most case. So that shows you that it's pretty stable. Same with your average net profit per trade. Look at how high it is above the line versus how low it is below the line. Each one being a weekly total. So that shows you a lot of stability. The profit factor, it's hard to see here, and it could just be because of the scaling that we're looking at. But anyway, again, not necessarily the subject of this call. What we're going to do is we're going to set up a test, a study that shows how your equity curve and your account would have grown using the power of compounding. Okay? So the first thing we need to do is set the risk factor to the average net loss. The average loss. And the average loss is $25. So looks like you pretty much are there. And then what's your starting capital? You don't have to tell me your starting capital, but the starting capital you want to use for this test. What?
Yeah, use 10,000. Yeah, just use 10,000.
Okay. And then we're going to risk.
Yeah, just use 10,000.
And since this isn't perfect, I mean, the UTA looks at each line item as a separate trade, and we know that a block of 4 is one trade. So we kind of have to, you know, just think through it a little bit. So per line item, if we want to risk 2%, then really we're risking.
I thought it would be 0.5. What did that mean? 0.5 per trade?
Yeah, that's a 0.5% risk per trade. Yeah, so that's correct. And then we're going to see if we could trade this plan with this $10,000 startup with a $24.55 average loss and 0.5% on each of the 4 positions to equal 2%. Now, what this shows us here is that if you did not add any position size, you would have grown the account from $10,000 to nearly $19,000 with the, 1 and 13 months worth of data roughly. And this shows you your costs. And you've got 50-cent commission per position and a 50-cent slippage per position. And so
that's roughly a tick.
Okay. Yeah, that's probably pretty good, especially if you're going into a trade with stop limit orders. You're reducing some of your slippage. Anyway, that's fine. Let's see what would have happened. So you click on the equity curve button here. I'm going to assume you've saved it, so I'm not going to save it now. And we're going to use that, that range. And then it's going to run this amazing study. This usually gets people to go, ooh, wow. And rightfully so. All right, so here's the magic. Remember what we showed, that you would have grown your account after subtracting the costs from $10,000 to nearly $19,000 in a year. So that's almost 100% growth with only winning 56% and with the drawdowns that you've shown. Now, who on Wall Street's going to do 80 or 90% returns in 1 year? It's unheard of. But you just showed how this plan produces that if you're executing it as you're posting them, right? There's going to be some There's going to be some margin of error, but there's lots of room for that. Now, that's only with one contract. When we add the fixed fractional money management and the 2% risk, you would have grown your account from $10,000 to $47,552 with the same trades and up to 9 micro contracts per line, per 4 positions. So ultimately, it's 36 micros if you're trading all 4 positions, targets 1, 2, 3, and trail, which you probably won't do, but who knows? But the point is that you would be up to 36 contracts, okay? But remember, the UTL only looks at one line item as a trade. So again, we have to think through it. It's not perfect. But do you think you could have traded from here to here, starting with $10,000, knowing that a year later, in 1 year, that your account would have grown to $47,552?
Wow.
Yeah, 1 year. Imagine what year 2 is going to look like. Now, you said
you gone from 10 to 47.
Now, when we go back to the data window, you set a cap at 100 contracts, 100 micros, and that would be per line item. By the end of the year, we're up to 9, right? So with power of compounding, which creates an exponential curve, it's very possible that by the end of year 2, or even before, you're able to hit your maximum 100 contract limit. At which point you go to the mini and you start trading mini contracts instead of micro contracts. In fact, you may even start doing that now, because after 1 year, you could put 4, well, maybe not. Maybe you want to get up to 10. I don't know. You have to do the math on when you're going to go to the mini instead of the micro, which will lower your costs because your commissions will go down. There's another piece of information that's exciting, and that's this down at the bottom here. This is the percent of trades that you are actually in drawdown. 87% of your trades you're in drawdown. Now you might say, oh, that doesn't sound very good. But my way of thinking is that sounds incredible. And this is the reason. That means that better than 10%, 13% of your trades, you are making new equity highs. So if you do the math, just pretend it's 10% for a minute. 10% would be 1 out of 10 trades you're making a new equity high. But this is better. This is 13%. It's like 1.3 out of 10 trades. So 13 trades out of 100, you're making a new equity high. Now, we know that you can never just make 100% equity highs. But if you know that you are regularly making them, and it's illustrated in this when we see it, right? This is what that shows us. It's just stair-stepping its way up. It's a really good equity curve. Now, you're also trading during a time when the market's not as reliable, when it's flakier, it's before the market's open. You're fitting a trade plan in to work with your personal lifestyle. So those are all benefits that you can't really put a number on, right? You can't quantify that. But you have to remember that because you've kind of compromised some numbers. You've compromised a profit factor. You've compromised a winning percentage. You've compromised some things that are acceptable to you because it allows you to trade profitably and still get to work on time and still live your life the way you want, right? So this is backpack trader style, and you're also containing it. What's your power of quitting? Is it how many wins?
So right now, if it's the first win, if it's a target 2 win, then I'm done. It's either 2 target 1 and break evens, or 3 total trades for the day.
Great. So 3 total trades, or target 2, or 2 target 1s, whichever comes first, right. But no more than 3.
Whichever comes first.
Yeah. And a hard stop time on when you have to go to work?
Yeah, hard stop for me is at 5:45 a.m.
Yeah, and you're on the West Coast, so it's really early, way before the market's open. But this is active enough so that you can create, your win rate is, it's better than casinos and blackjack. and that's a gazillion-dollar industry. And you're showing here that with power of compounding, that, I mean, what's $10,000 to $47,000? Is that like a 470% return?
400, yeah.
So it's a 470% return in 1 year. You see how this tells the story in a way that helps you now believe? This helps create the foundation for you to run this like a business, doesn't it?
Yeah, absolutely.
It's amazing. All right, so let's look over here. This histogram is a good representation of what I like to call the ramp. And the front end of the ramp is always the hardest. It's the longest. It's when you're starting with the least amount of money and you're trying to grow your account and you're taking position. By the way, this histogram represents positions going on and off, on and off, on and off. But notice over time how it stair steps up and up and up and up. And that's just the first year. And we saw that we grew to 9 contracts, because here's your drawdown. Your drawdown is being represented by, well, you got to 11 contracts, went to 10, went to 9, back to 10, back to 9. But look at what happened prior. The same activity, the same dynamic. And when you see this, it helps, again, create that foundation of belief so that you can, you know, this is just part of the ebb and flow, the mysteries of a winning trade plan. It's normal. You started with, what, 2 contracts, because that's what you could afford, and then you instantly hit drawdown and had to go to 1, but then right up to 2 again. And this is only with a 56% edge. I mean, you're only 6% above 50-50. I mean, sometimes you're at 60%, and I'm sure when you're growing and growing and you're getting the winning streak, the win rate is going up. Again, that's a moving line in the sand. But this is pretty cool. This is really, really good, considering you've given up stuff, right? You've given up stuff to fit your lifestyle. Watch what happens when we do this. What happens? Let me try this again. What happens if you're like, you know what? I got $10,000. It's not my only money. If I lose it, it's not going to be the end of the world. I don't want to lose it, but I wonder if I could afford 3% instead of 2%. So you can change this to 0.75, right? 3/4 of a position. So that's going to be 3%, isn't it?
Yep.
1.5.
4 positions, yep.
Yeah, 4. Yeah. So just by putting on an extra 1% across your 4 positions makes a huge difference. Let's see what it is. I always say 2% is a good guideline. It's a good benchmark, but you have to assess your own personal situation, your personal goals, what your risk tolerance is. Your $10,000 just grew to $115,000 in 1 year. And the drawdown episodes didn't really change much. You're still making new equity highs 13% of the time, but you traded up to 34 micro contracts per position. So when you get to the year number 2, how about going to the mini contract, the $20 a point, and just trading, instead of 34 contracts per position, 34 micros, just trade 3 minis per position. And you're automatically going to reduce your expenses a lot, and you're going to explode. Year 2 is going to explode. I mean, this trade plan is on track to solving all your financial issues in your life. And it's not even the most optimal plan, given the circumstances. It's just a mediocre plan, but which is good enough. Mediocre is great when it could turn $10,000 into $115,000.
I don't think anybody's going to complain about that.
I don't hear you. I don't hear you complaining.
Yeah, I mean, well, you know, I haven't complained at all.
How might you improve now? Because you have a good plan. Now, if you could tweak it and make it a little better here, a little better there, add a percent here, add a percent there, look what it could happen exponentially. We just added 1% to the risk, but what if you could add a little bit more to the win rate? Another thing you could look at, which you've done already, but time of day, during the times you can trade. Have you set this up in your spreadsheet? Because you could, what's your window of time?
I don't think I did.
What's your window of time that you're trading?
Oh, it's 4 a.m. to 5:45 a.m.
4 a.m. to 5:45. So what you could do is you can come here. You can go to...
That's actually 6 to 7:45 exchange time. That's what I've got on my UTA.
Right. Okay, so let's expand view. Let's go to time of day. All right. So you the first time is, you say 6? Okay, so you kind of have it done here. You have from 6 to 6:21. It looks like you've put some thought into this. You've broken this up into different windows of time. And I'll tell you right now that if you eliminated 6:21 to 6:42, you might change everything. Look at the profit, the average net profit per trade on the first 21 minutes. This is only 11 minutes, right? So these are pockets of time where you have better results or worse results. You could play with these numbers. Remember, if you change a yellow, it instantly starts the next window at that same time. And your profit factor really jumps up here. Like these last three, like what if you started trading at 6:42 instead of at 6? Your results would probably be dramatically better. And that's amazing information that you can only get from doing the work that you did. We call it the ditch digging of trading, right? This is how you pour your foundation to create a winning trade plan. After all, you're just one trade plan away, right? I had to get that in there.
Trade plan, that's it.
All right, so look, this, we've been on for about 30 minutes. It's about how long I said I had. So this is what trade hacking and trade plan hacking is all about. So I appreciate you sharing this and looking forward to talking to you again soon.
Thanks, DJ. I appreciate it, man.